when I was an undergraduate taking economics, went to Johns Hopkins and had an excellent economics department. And I really, when I was taught, classic Keynesian theory, and I really I struggled with it. I said, this doesn't make sense to me. I said, I must not be a very good student. And decades later, I realized it was all junk. So it was, now I know why I didn't get it, because it didn't make sense then. Since then, since 2009, Russia has increased its gold reserves 70%. China has increased its gold reserves several 100%. No one knows the exact number, but you can estimate that order of magnitude. So everything we did in 2009 has played out exactly the way we warned the Pentagon it was going to play out. So you kind of had the last laugh on that one.
That was a video of a real conversation that my friend Jim Rickards and I had on Hedgeye TV a little while ago. We were talking about, I'm trying to think of what the date was. I don't think it really matters. The point is that we were reviewing the currency wars, all of his really pioneering work in where we are today. And it's really, I'd say, Jim, welcome, but it's also come to the fore pretty quickly.
Thanks, Keith. Great to be with you.
Yeah, indeed. So what do you, where do you, when you get up in the morning today, or post the Swiss move, or any other day the Canadian move, does it surprise you at all?
Not really, and this is one of the points I made in my first book, Currency Wars. I make the point that we're not always in a currency war, the world's not always in a currency war, but when you're in a currency war, they can go on for 5 or 10 or 15 years. That's not surprising, they have in the past. And there's a reason for it, which is that they don't have a logical conclusion. If you and I are trading partners, and I'm going to steal growth from you by cheapening my currency, or I want to import inflation from you because I need more inflation, which is really the driver right now. So I can do that, but then you can do it back in retaliation, or imagine a much more complex game where you've got 50 or 60 countries all taking turns devaluing against each other. How does that end? I mean, the answer is it doesn't. It keeps going until one of several things happens. Either the system collapses, which it has several times in the past 100 years, and you've got to, all the major powers have to get together and rewrite what they call the rules of the game. So that's one exit. The other way is without a collapse, you get some, I'll call it adult leadership, James Baker, someone of that stature, or Kissinger, or somebody like that, and you come together as they did at the Plaza Accord, and you just say, okay, here are the new exchange rates. So it's not a fixed rate regime, but it's sort of a de facto fixed rate regime where we all agree on what the new parities are going to be. So you need leadership, you need a multilateral conference of some kind, formal, as at Bretton Woods, or a little more informal as at the Plaza Accord. But either way, you need one of those. If you don't, it just keeps going on. So what interests me, or I'll say amuses me, is you wake up in the morning and the Swiss thing happened, or overnight the Singapore cut rates, the Singapore dollar, they trash the currency, and people go, oh, it's a currency war. It's like, well, of course it is, but it's the same currency war we've been in since 2010. And it's going to go on until 2000, pick a date, 18, 20, 2020, until the system either collapses or you have this this reformation. So it's going to. I'll come back a year from now, Keith. We'll still be talking about it. It would be my expectation. So I'm not really surprised at all. This is how they go.
But you don't get leadership until you get some peak at collapse or collapse, correct?
Well, I disagree a little bit because, yes, if there's a collapse or a crisis, then they'll have to have leadership. They'll have to do something. But leadership is getting out ahead of the collapse, saying, hey, this is going in a bad direction. This is a negative-sum game. This is destructive. Let's do something about it. But again, you go back, you look at Bob Rubin, James Baker. They took different views on things, but they were the kind of people. Now, we have Jack Lew. Jack Lew, I don't know him personally, I take it he's a perfectly bright guy, but he's kind of a type A bean counter from OMB who was sent over by the president to really fix the budget deficit. And they did cut the deficit, you gotta give him credit for that. He knows, as far as I can tell, almost nothing about the international monetary system. The last really talented person at Treasury who knew a lot about the international monetary system was Lael Brainerd, who went over to the Fed. So she's, it's sort of it's nice to have her at the Fed, but there's really nobody home at the Treasury right now who understands the dollar. Geithner understood. Now, you could agree or disagree with his policies, fair enough. But Geithner sort of grew up in this world, grew up abroad, worked at the IMF, went to Johns Hopkins SICE, which is sort of intellectual boot camp for the IMF. So he got it, but I don't see anyone at Treasury today who understands the international monetary system. So we don't have a James Baker on the horizon.
No, that's a problem. So we're back and forth, and we were just before you came on talking about volatility. Really, the all-time low in volatility across asset classes was, as you know, in late June or early July. And people generally, they don't look at volatility, they look at the VIX or something, but the reality is that across foreign currencies, fixed income, all asset class. It was the all-time low.
Right.
And it was really that point where you had like some thrust from both the Europeans and Japanese, and now we've had these most recent moves, to your point, Singapore, Switzerland, Canada.
Right.
How do you think about the timeline versus the first movers and this most recent group of movers, and what would you look for next?
Well, the greatest leading indicator of extreme volatility is low volatility. It sounds kind of an obvious statement, but the point is, when you have a sustained period of low volatility, you get complacency, you get over leverage, you get stretch for yield, you get too much risk taking, you get all the behaviors that set you up for extreme volatility, and that's exactly what we had from everyone from central banks to individual investors. I mean, I think leverage on the New York Stock Exchange is at or close to an all-time high.
The margin debt's at an all-time high.
Right. So there's an example.
But they say it's different this time on that front.
Well, it's not, as we know. The exact circumstances, the way it plays out, are always different, but the results are pretty predictable. So I think the fact that we're now entering this period of much more extreme swings, volatility, is really not surprising. If you look at various measures of volatility, different ways to measure it, stock market, et cetera, from 2009 to 2015. And you look at it over a longer time series, maybe 30 years. You look at that patch, that 5-year patch, you say, what does that resemble? What does that look most like? Well, it looks like 2002 to 2007. In fact, it looks exactly like it. And then, of course, we had this heart attack in 07, 08.
Right.
So I'm expecting the heart attack. I think it was an EKG. The patient's about to have another heart attack.
Now, what do people, I guess Peter Thiel said this the other day, certainly don't agree with him on a lot of things, but on this one I do, which his basic question is, what is it that you know, Jim, that is the truth that everyone just doesn't quite get yet?
Well, I would say that I don't have any facts, or very few facts, that aren't kind of widely available. So I don't have any secret inside information.
Crystal ball.
Yeah, I don't have a crystal ball. I don't have kind of secret inside information. I have interesting conversations around the world. That's fun. But others do as well. And we all know what it's like with instant digital media. I mean, one of the funny things about writing books, I've got 2 books and working on a new one now.
You're working on a new one?
My new book will be out in this time next year, so it's not imminent, kind of
awesome.
2016. But the funny thing about books is, they actually do take a year and a half from start to finish.
Yeah.
And everyone's into the instant digital gratification, get that blog, get it out, get the hits, et cetera. So my point is, there's not much that doesn't get revealed in real time, and between retweets and web and venues such as yours, but people see it. So I don't have information. My history's not different. My facts aren't different. What is different is that I use different models. And that's a big deal, because if you have the wrong model, you will get the wrong result every time. And people look at the Fed, they look at the policies, and they go, "These guys are idiots." Of course, they're not idiots. You've met them, I've met them. I mean, they're twice as smart as I am. They have 160, 170 IQs. There's no doubt about that. But it doesn't matter if you're using these ISLM models and quantity theory of money and various equilibrium models. You are going to get the wrong results. So I would say I don't have better facts. I'm not smarter. I don't have a crystal ball. I have better models. One of which, by the way, is part of what I use is something you've been talking about recently, is Bayes Theorem, which we use quite a bit in the intelligence community. Use it quite a bit at the CIA. And the reason is, if you think about what does Bayes Theorem do? When do you use Bayes Theorem? If you had a long time series, maybe for the viewers, we could just do a
we have
30-second
well, because Bayes Theorem, I think,
on that.
because I actually ask, I think our institutional clients are fairly sophisticated.
Right.
I'd say that 70% of them don't know what it is.
Right. Bayes theorem is a statistical method you use when you don't have enough statistics. In other words, there's a debate, or actually a long-running, several hundred-year debate among statisticians. So some of this stuff is very geeky. I mean, you think finance is geeky, try statistics, but between what they call the Bayes theorem and the Frequentist. And Frequentist, as the name suggests, frequency. You have a lot of data. You get long time series. Well, if you have enough data, you have enough, long enough period of time and enough examples, enough data points, you can use Monte Carlo simulations. You can use, look at degree distributions, whether they're normal distributions or power laws or whatever, and draw some pretty good conclusions. The problem is, most of the time, or often, we don't have enough data. And what do you do then? Well, the frequentists would say, well, you can't do anything. You just throw up your hands, wait for more data. If you do anything else, it's not science. And this was sort of the wrap on Bayes' theorem, but the rebuttal was, well, no, sometimes we don't have the luxury of that. And there's a new movie out, by the way, The Imitation Game, about Project Ultra and cracking the Enigma code.
Yeah.
And that was a problem they'd never seen before. They didn't have enough data to do it in a normal statistical method, but Churchill said, sorry, if you guys can't fix it, we're going to lose the war. England won't exist. Yeah. And so you're put to work solving a problem where you don't have enough data. So what do? It's called inverse probability. Instead of reasoning from cause to effect, you reason from effect to cause. What's the cause? Well, you have to hypothesize something. You sort of have to guess. In science, scientists hate the word guess, but sometimes that's what you do. You guess, and you assign your guess, called a hypothesis or a prior. You assign your guess some probability of being correct. Then you look at events that follow from that, and you say, what is the likelihood that this event would be caused by this? Relative to all the events possible. Right. So it's a simple ratio. And the answer is, if that's a very high probability, you're now validating the cause, even though you didn't have reason to think so in the first place. If it falls away from that, then you have to change your prior assumption. You have to say, well, abandon that and try something else. We had an example of this in after 9/11. We were doing counterterrorism work, and one of the things we were trying to do is think about whether if there were another, what we call spectacular attack, and that means a very tragic, high casualty, high impact attack, such as 9/11, would there be insider trading on that? Like if you knew about it, would you be tempted to go out and buy some puts on American Airlines, which is what happened, by the way. There was insider trading ahead of 9/11. Would you do that? Could the intelligence services spot it if they were looking for it? Could you model that? If you found it, could you get a FISA warrant, break down the door, and stop the attack and save lives? That was the project that we were doing. Well, we had ways of thinking, of kind of identifying those anomalies, really no different than what high-frequency traders do and stat arb guys do. We were basically taking Wall Street techniques and bringing them over to the intelligence service. So what do you look at? Momentum, volume. You look at how a certain ticker is doing relative to the sector, relative to the market, et cetera. So the statistical techniques were there, but the problem is we had 6,000 tickers on the New York Stock Exchange and NASDAQ. Well, you take all these factors and do them in time series and do a covariance matrix of 6,000 tickers. The processing you need for that is enormous, and we had, working with the government, we had limited budgets. So what we did, we said, okay, they're probably not going to attack a dairy farm in Vermont. That's probably not on the list, and maybe Ben & Jerry's is up there, but it's not an al-Qaeda target. What are they going to attack? They're going to attack airlines, cruise ships, theme parks, various high value. There were a set of targets. Well, we used that to kind of narrow it down to about 400 tickers. Now, the point is, what statistical basis did we have for doing that? Well, Al-Qaeda's never attacked a cruise ship. They've never attacked a theme park. So how did we do that? Well, we used common sense. We used some of what they said. Al-Qaeda said, these are our high-value targets. So that's an example of Bayes' theorem, which is we didn't have the luxury, as Churchill said, England's going to lose the war. We couldn't wait for 1,000 terror attacks to have a large statistical database. America there would be nothing left of America. What we had to do was use common sense, use inference, et cetera, and then test it. So that's an example of Bayes' theorem. You can use that, you can apply that technique to the Fed, and that is what I'm doing. That is what I'm doing with regard to, I'm expecting no interest rate increase in 2015.
We have the same model and we have the same posterior.
Right, exactly, yeah. Exactly. So what you can do is you can say that without knowing if it's true or not. You believe it to be true. You obviously we wouldn't put it out to clients, and I wouldn't put it out to subscribers and readers if I didn't believe it to be true. But you can't prove it in some kind of Monte Carlo simulation. But using that as your prior, then you can look at events to validate it. So far, it's holding up very well.
Big time.
So I'm sticking to that call. It's interesting. I said this 6 months ago. And everyone was like, well, they're going to raise rates in 2015. Yellen has signaled that. And the debate was March and June. You had your March guys and your June guys. Well, all of a sudden it's like, well, is it June or September? Give it a few more months, it'll be September, December. Now you're into 2016. Yeah. So it looks like that call is going to be validated. But again, I wasn't inside the room. Actually, what's interesting is
you don't need to be.
Well, that's right. But I would take it further. I would say you could be inside the room and not have better information than that, because they're still talking about,
of course,
possibly increasing interest rates.
And would you have been able to make a lot of money on it? No. By the time you're in the room, and now the Fed today, today's an interesting day to be doing this. They're going to tell us what they're talking about in the room.
Right. But
what they've been talking about is what the bond market has been signaling the entire time.
Correct.
So we don't have to get this. We were talking about it earlier. I mean, what is the value in the old wall way of calling up some guy in Washington and saying, yeah, she's going to move?
Right.
No, there's a certain behavior that she adheres to, and there's a certain prior that we can observe and start to see her really being moved by the data.
Right, so am I smarter than Janet Yellen? Absolutely not. Do I have better information? I'm not inside the room. Right. And so how can I make a call that she doesn't see herself? The answer is she's using equilibrium models. I'm using complex dynamics, behavioral economics, and Bayes Theorem to come up with a better way of looking at it. So really, that's the way investors can get an edge, because we're all uncertain to some extent. I mean, the funny thing is, I do talk to insiders from time to time, and what they'll tell you is, I've spoken to members of the Board of Governors, voting members of the FOMC, Reserve Bank presidents, and they will tell you privately, we have no idea what we're doing. I mean, they say that. But we have no idea what we're doing. We try something. If it works, we might try a little bit more. If it doesn't work, we might back away and move in a different direction. They will admit privately that this is an experiment. And I had a very, I'll say scary, even though it was over wine, it was a pretty friendly discussion with, I'll call, without naming names, the ultimate Fed insider, somebody who would know more about this than anybody. And we're just kind of musing on this, and he said, what we call QE, I said, well, what do you think about QE, the evidence? He said, we use the word murky. He said, inside the Fed, inside the room, we use the word murky to describe whether it works or not. So right away they're saying, we don't really know if it works. Maybe it was better than not trying it. Very hard to measure the effect. But then he said a very interesting thing, which goes to what we were just saying. He said, 50 years from now or 60 years from now, there'll be another episode like this. And there'll be a future Ben Bernanke, some young scholar of the year 2080, who will go back and look at the 1930s, the way Bernanke looked at the 1930s, and we'll look at the 2000s, 2007 to 2015, and study them, and he'll have 2 data points. And I almost fell out of my chair. I said, oh, so we've got to wait 80 years so you can get 2 data points so you can figure out if this is working or not. Meanwhile, we're in a war. We're in that existential frame that Churchill said, we don't have the luxury of waiting 80 years or maybe 80 years after that so you could have 3 data points. We're either going to trash this economy or get it back on track. So again, the kind of statistical techniques, Bayes theorem, other complexity theory, other causal inference or inverse probability methods are what we have to do because we have no choice.
And for those of you watching, I highly suggest you look up and do your own research on this. Just go to Wikipedia. You can see the difference between what a frequentist is and a Bayesian inference process. So again, a frequentist, you see a lot of this gobbledygook from Wall Street, really, which is, people are just driven by data. They're trying to be macro people, but they really have no process to do macro. That's a problem. Right. But again, we have a Bayesian inference process, which is constantly changing. Again, you're seeing reactions to things that are constantly and dynamically changing. Again, whereas a frequentist process, you'll just throw a stat out saying 19 out of 22 times that this has happened, this happens. Right. Okay, well, what happens if you put up all your money on that and on the 23rd time it doesn't happen? Oh, this time is different.
Right.
That's it. People want, my sense is, and this is a question, are people so insecure about what they do in this profession that all they have left is trying to find somebody to cling to certainty at this point when they should be doing absolutely none of it?
The answer is yes. And there's a good story. Dan Kahneman won the Nobel Prize in economics. Interesting that he won the Nobel Prize in economics. He's not an economist. He's a sociologist and behavioralist. But he was, I think it was one of the few Nobel Prizes in economics that was sort of well-deserved versus the pseudoscience of efficient markets and normal distributions. But he tells a great story. He said there was a Swiss Army patrol. It's a true story. They got lost in the Alps. They were on patrol, and a blizzard came, and they were completely out of touch. No radio contact, no visibility. They were out there for 3 days. Their headquarters had given up on them. They tried to rescue them, but the weather was just too bad. They were going to be frostbitten or whatever. Anyway, long story short, they come back. They make it back to headquarters, and they're, like I said, they're dehydrated, hypothermic, frostbitten, but they survived. And the commanding officer says, "That was amazing. How on earth did you survive?" And the officer said, "We had a map," and he pulled out the map. So the commander looked at the map. He goes, "This is the wrong map. It wasn't the area you're in." He says, "But we had a map." Yeah. And the point is, it gives people hope that they can cling to something. It doesn't even have to be the right map. It doesn't actually have to help. You just want to feel that you're in the crowd or you have something to cling to. And there are some, by the way, I'm not against statistical method or Monte Carlo simulations if you have enough data.
Well, actually, current Bayesians would say there's actually a great book, I don't know if you've read it yet, it's called The Theory That Would Not Die.
Right.
And it actually shows how a lot of current Bayesian statisticians are using Monte Carlo simulations within They're just trying to narrow their preliminary preliminary gains.
If you have enough data, it works fine. I'm not anti-science, but it's the times when you don't have enough data. But one of the things where there is some data, there was some sociological research published. It showed that that economists are wrong 70% of the time. Now,
the Fed's forecasts have been wrong 73%.
Well, no, the Fed's forecasts have been wrong 100% of the time the last 5 years. They do a one-year forecast, 1 year forward. They've been wrong by orders of magnitude 5 out of 5. So they're batting zero. But the economics profession, Wall Street, et cetera, wrong about 70% of the time. Now you think about all the binary outcomes. Markets up or down, interest rates up or down. There are a whole bunch of binary outcomes that people look at. A monkey throwing darts would be right half the time. If you had like a yes/no thing, they're gonna be right half the time. So economists who are trained, who are professional, who spend all their time thinking about this, do worse. My prior would have been, well, you're right half the time because the binary outcomes, randomly you're going to be right half the time. They're actually right 30% of the time and wrong 70% of the time. Why is that? Because they would rather be wrong in the consensus than right out of the consensus. Right. In other words, first of all, they start with the wrong models, okay? So the first couple of people who say something are probably going to be wrong because they got the wrong model. But then where it's non-random is everybody gloms onto that. It's a network effect. And so they're all in the pack, and they would, believe it or not, and I find this professionally repugnant, they would rather be wrong in the consensus than right out of the consensus. But here's why.
Disgusting.
Because if you're out of the consensus, you'll be right some of the times. You'll be wrong some of the times. We all miss a few. Ryan Howard struck out 13 times in the '09 World Series, but it doesn't mean he's a bad ball player. But the point is, if you're out of consensus and you're right, they'll say, well, he was lucky. If you're wrong, you'll get fired. Well, what were you thinking? Right?
Yep.
If you're in the consensus and you're right, pat yourself on the back. And if you're wrong, it's like, well, everyone else was wrong too. So being in the consensus means you get to keep your job. Being out of the consensus means you're rolling the dice on losing your job for the times you'll be wrong.
So people are actually behaving on their own compensation incentives.
Well, it's logical behavior if you're trying, as Mel Brooks would say, trying to protect your phony belonging job and trying to get paid and trying to get a buzz. So it's rational from that purely selfish perspective. But what good does that do investors?
It's terrible.
It's terrible. That's the point. That's your point. I'm saying the same thing.
So when you take that a step further, and the question that I had earlier is like, what is the truth? Again, this is a Ray Dalio question, but pretty basic question. I don't think that he was the first one to ask it, and I think my dad asked me many times, "What is the truth, your son?" But what is the truth? And now you see almost a manifestation of what I'll call mainstream media. Not to name names, but it's fine to do that here. Bloomberg starts the Bloomberg Economics editorial, whatever it is, which is just, to me, almost like a half-baked version of a bunch of tried-to-be old Wall Street economists, weren't even good at being good at that. But that's promoted. And then you got Twitter, and you got the interaction of all this consensus is actually, to me, it feels like it's getting louder. I don't feel like there's a lot of I can't see a lot of Jim Rickards on Twitter. It's like we're like unique, weird beasts or something.
Yeah, well, look, we all know there's been this proliferation of channels, whether they're cable TV channels or web channels or streaming or Twitter or whatever. Massive, massive proliferation of channels, exponential.
Massive.
Has there been an exponential increase in creativity, original thinking, people very devoted to the kind of problems that you and I are trying to solve? Probably not. That's probably a lot more linear. And so when you
as a percentage of the total, because the total is getting bigger, it's actually quite low.
Correct. So you put sort of a linear increase in creative thinking, if that, with an exponential increase in channels, then it's bound to be the case that you're going to dilute the quality of what's out there. And you talk to anyone in media, from Rupert Murdoch, Roger Ailes, he's the smartest guys in the sector. They're trying to figure it out. Everyone's trying to figure it out. So you do get an echo chamber. I mean, they really need to sort of single anybody out or disparage anybody. And I know we're not doing that. The point is, people are doing the best they can, but it is very difficult to break out of a paradigm when everyone's been trained a certain way, learned a certain thing. Particularly if you're a little older and you've spent 20, 30 years doing it, it's very hard to throw away that knowledge and get new knowledge, because you're like, hey, I worked really hard to understand this. The fact that it's wrong, the fact that it doesn't describe reality, doesn't enter into the equation. It's like, well, I worked hard to grasp this, so I'm going to keep doing that. But that's one of the problems.
So you think about that demographically. I mean, you're really, a renaissance man in that regard. You started as a lawyer.
Yeah.
You're just like, I got to think about this in my own framework. You started doing your own work, doing your own reading. You really self-educated across the board on this. And then you have a bunch of baby boom guys that probably won't stop thinking this way until they're dead.
Well, I read, that's right, and it is very hard to change up. But I did have a, called a wake-up call in August, September 1998. I was one of the partners in the long-term capital management fund.
That'll wake you up.
Yeah, that'll wake you up.
Yeah.
And I was the lawyer, and I like to say, you know, I was on the involved with the management committee, but I was not on the risk committee.
Yep.
Until the end, when there was not a risk committee meeting that I was not in, but that was in the intense period. But you know, I like to say in America, when you screw up badly enough, the lawyers get to take over. We saw that in you know, in Andrew Ross Sorkin's book. It was all lawyers at the end and government officials.
Yeah.
The principals were kind of like, you guys, you know, just sign here, is sort of what they were told. So that was one where it got really bad, and the lawyers had to take over, and I was the general counsel for long-term capital management, so I got to do that bailout. But I had, you know, candidly, I had a lot of money in that. I was like, hey, well, you guys won the Nobel Prize. I'm just a lawyer. What do I know?
Yep.
So, you know, I'll sign up with you. And I had a setback there. I lost a lot of money in long-term capital. So I came out of that. I was like, okay, as a lawyer, I did my job. You know, it's everyone got back on their feet. You know, the guys started GlobeOp. They made $1 billion on GlobeOp. Myron Scholes started a $2 billion fund. JM started a new fund. Everybody got back on their feet. Came out of it legally without a scratch. Think about losing $4 billion in 1 month, and there was no enforcement actions, no lawsuits, and there shouldn't have been. I mean, it was. I like to say we lost money the old-fashioned way with honesty and hard work. But the point being, I felt as a lawyer I did my job. It was like, you guys, you know, the PhDs, the 160 IQs, the Nobel Prize winners, didn't do your job, because if what you were doing was right, this wouldn't have happened. Exactly. So I sort of set out on a personal quest. I knew how to be a lawyer, but I didn't know as much about risk management or financial risk management, although I had been in the bond business and derivatives business for a while. But I said, well, this doesn't work. So why doesn't it work? And I studied that for about 5 years, and then I understood why it didn't work. But then I sort of got to where Nassim Taleb did in The Black Swan. He said, well, this doesn't work. He took a baseball bat and smashed the bell curve, and, you know, good for him. That needed to be done. But then he just sort of threw up his hands and said, I'm a philosopher, and walked away. And I didn't want to do that. I wanted to say, well, let's keep going and see what does work. And I studied applied mathematics, physics, network theory, graph theory, behavioral economics, Bayes Theorem, and all the things that we're discussing, Keith.
And you had a lot of people accelerating along the way while you were doing that. Like Kahneman, really, Tversky, that work came to, you know, really was
right. And there was this convergence. You know, even you know, behavioral economics is very powerful stuff. It really works well. It's not the whole story, but it's an important part of the story. That has seeped in. You can actually go to Harvard, and you know, Larry Summers will talk to you about behavioral economics. But complexity theory, no. Bayes theorem, no. Those things really have not penetrated economic thinking. As I say, I go out to Los Alamos, and that's all they talk about. I mean, they use Bayes theorem to solve problems that that can't be solved any other way, that have to be solved. So I find the physicists are a very congenial audience. My PhD economist friends, not so much so. They say, well, you have really nothing to tell us. So.
Well, those are, I mean, there's a legacy to that.
Right.
I mean, in what is easily one of the biggest funds that everyone would know if I gave the name, the top, they just gave him $1.5 billion to start a new global macro fund. He's 29 years old.
Right.
He is a Bayesian theorist.
Good.
Okay? This kid, he's not a kid anymore, but he came out of Harvard learning what not to do.
Right.
And this is the future of finance. I feel when I wake up in the morning that I'm not looking at the future of finance.
Right.
And that, to me, that's like, you know, people would call guys like you and I pessimists. They'll call us, you know, when you don't know what to call somebody, you just call them names.
Yeah, doom and gloom, pessimist, whatever.
But I, like, to me, like, I really feel like an optimist when I think of a better path, when I think of complexity theory, when I think of Bayesian inference. I mean, how do you feel about that?
Well, yeah, you do get beat up a lot. If you want to get beat up, just go on Twitter, because, you know, you could have 50,000 followers, overwhelmingly complimentary, but it just takes a couple of trolls to ruin your day. But they're out there. Fortunately, very few. But I have good interactions with the Twitter following. But you're right. I mean, I'll paint scenarios using not just making them up. I'm not a science fiction writer. Using the kind of scientific techniques we're
Not a
talking about.
science fiction
And
writer.
they're pretty, you can say gloomy. They're pretty negative. And people say, well, why don't you shut up? Is where people kind of say, why don't you shut up? Because if you talk about this, that it might happen. I say, well, there is the self-fulfilling prophecy, but there's something called the self-negating prophecy, which is if you put a forecast out there and it's bad enough, maybe it serves as a wake-up call, and maybe people's behavior will change today in such a way that your forecast doesn't come true, not because you weren't right to foresee it, but because you're actually, you're Paul Revere. You've actually been able to give people a little bit of a wake-up call. So that's the optimistic side of me, which is, I can take care of myself. I'm not worried about myself. But the point is, there are a lot of investors out there, and people say, why do you do what you do? Why do you write books? Why do you, lecture and all that? And what kind of drives that? And I always think of my 83-year-old mother. Because my mother's fine, thank goodness, but she's the ultimate fixed income person. She's got my father's pension. She's got her own pension. She has her home equity. She's fine, but she doesn't invest in hedge funds. She doesn't have a lot of alternatives, et cetera. And if inflation takes off, or the value of the dollar comes into question, or there's serious financial disruption, she's the kind of person who will suffer because of that. And I got a call from an 80-year-old lady in Florida, and she said, I get unsolicited calls and things like that all the time. I tried.
And you actually pick up the phone.
I try, but she said, look, I've got $100,000 in the bank, and I'm getting nothing, no interest. So thank you, Janet Yellen. But she said, I used to get like a couple $1,000s a year, and that paid for my meds. Because even at 2%, which would be a normalized interest rate, five years into recovery, 2% would be a normalized interest rate on 100,000. You should get $2,000. She said, that paid for my meds. Now I get zero. What do I do? Well, Janet Yellen's answer would be buy stocks. Except that an 80-year-old woman with $100,000 to her name can't afford a 30% drawdown, which is what you do see.
You mean she shouldn't buy GoPro?
No. Maybe wear one. She's out surfing. But the point being, stocks are not right for everybody. Risky assets are not right for everybody. Even people who can afford the losses shouldn't be in them for the wrong reasons. Certainly not at these valuations. And so the Fed's answer to her is not a satisfactory answer. It's like, hey, go roll the dice. Help us create a wealth effect. By the way, the economic research on wealth effects is very, very sketchy. I mean, there are papers that argue both ways. But it's clear that there's, at best, they're diminishing marginal returns. At worst, it doesn't even work. Some papers even say that there's a negative wealth effect.
Plus, it's pure frequentist sampling.
Correct.
I mean, we're talking about the mother of all wealth effects on the baby boom generation, which is going down the wrong side of the curve. We showed it in a prior presentation. So that's alarming. If you think about what you said, though, in terms, I think metaphorically, it's the right thing. I mean, this whole concept of a zero savings society, and a society that's getting older. I mean, that demographic curve is not going away.
Right.
How do you think about that in terms of both what the Fed does next? Because again, your view, my view is that the Fed gets easier, so you have 0% longer.
Right.
Then you also have a presidential cycle where you have Jeb Bush coming along, state of Florida, a lot of pensioners, a lot of old people that would love the $2,000 for their meds.
Right.
How do you think about that?
Well, there's an old saying, and as a lawyer, when you think about Supreme Court opinions, there's an old saying that the Supreme Court justices read the newspapers. Today they say they read the web. But the point is, they may be isolated, they may have lifetime appointments, but they understand the politics of the situation. I dare say the same is true at the Federal Reserve. In other words, when you get into an election cycle, can you imagine the impact of serious tightening? They did want to normalize interest rate. By the way, I favor that, just to be clear personally, but my opinion doesn't count. What matters is, this is a problem we call mirror imaging, where you take your own view of the world and you project it onto other people. My view of the world, I actually said, it's on CNBC on Squawk Box in August 2009, and I said the Fed should raise interest rates 25 basis points. Not a shocker, but just kind of get them back to normal. So I'm 6 years behind what they're actually doing. But my opinion doesn't matter. Janet Yellen's opinion does. And can you imagine them tightening and the effects of tightening in an election year? I can't see that. So that window is going to shut quickly. So this is their year to do it. But all of the, I actually believe the Fed when they say they're data dependent. Now, they don't know what the data is going to be because they've got the wrong models. But if they're data dependent, which they are, there's good reason to believe to know that. and you can see the data is going to be weak, then it's very easy to say they're not going to raise rates.
Oh, exactly.
Now if they do, my view is they're not going to. I've said that repeatedly. I'll say it again now. If they do, watch out. There's no floor at that point. I mean, they're just going to throw the economy into recession, sink the stock market, and that is not priced in. But anyway, it's getting pushed out further and further.
Team, if you can, just to Jim's point, that slide 12 where we say, meanwhile, the Fed should stay on hold. What I did, Jim, was basically showed 5-year forward break-evens, core CPI, where it's trending, tends to spread, just data that they are going to obey.
Correct.
You can front run their behavior if you know where the data is trending.
Right.
I mean, that's the point. So they end up in a place, I agree, where if they do raise rates, they're going to flatten the yield curve, like dead flat, which we haven't. That's the one thing that Bernanke and Yellen have been successful in doing, is not allowing gravity to occur on an inverted yield curve, which has happened across histories of time. It just hasn't happened yet.
Right. And I have, you talk about the generational perspectives. I was in the bond market. I was at Greenwich Capital, now RBS, in the 1980s. So I have a lot of friends from those days who are still in the bond market. They're running hedge funds or whatever. And they got their heads handed to them last year because they were short 10-year notes. They just like, hey, interest, and they still are, and they're still getting their heads handed to them. U.S. Treasury 10-year notes could go to 70 basis points. I mean, this, by the way, U.S. Going from 170 or 180, let's say 180 to 80, that's going to be one of the greatest bond market rallies in history. U.S. Treasury notes. Now, and the reason is, just look at where the Germans are. Look at where Japanese JGBs are. What, 20 basis points, 30 maybe.
Germans like 0.38 or something.
0.3. Okay, and then but Spain's like 1.5. So tell me, Spain's a better credit than the United States? It's not. So something's seriously out of whack. There are only 3 ways to resolve it. Either those European, Japanese, German rates have to come up, or U.S. rates have to come down, or maybe they meet in the middle somewhere. But that's it's still a bond market rally. And the way this is going to be resolved, because of the momentum, because of the data, because of the kind of things we're talking about, these rates are going to come down. Now, here's my friend's intellectual analytical error, and I think a lot of people in the marketplace, they look at these rates and they go, they're at all-time lows. They can't. They're at absolute all-time lows. Actually, interest rates are close to all-time highs. The nominal rates,
on a relative,
well, on a real basis.
Yep.
Nominal rates are near all-time lows, but real rates are near all-time highs. I remember when the 30-year bond was yielding 13%, but inflation was 15%. In other words, the real yield was negative 200 basis points. Today, the real yield is positive 100 to 150 basis points, depending on the metric you want to use. So real yields are very high. The guy who's picked up on this is Larry Summers. But by the way, the reason...
And the Japanese, by the way, they've paid, the JGB holder forever understood that real yield concept.
Right. So here's the thing. How do you get a negative real yield? Because the negative real yield means there's no project in the world that doesn't make sense, because the bank's paying you to borrow. You get to pay the bank back in cheaper dollars. So the bank is paying you to be a borrower. So there's nothing that doesn't make sense, right? So invest in everything. So how do you get that? Well, you have to have inflation higher than the nominal yield. It's simple. It's fifth grade math. Okay, so here's a negative real yield. Here's inflation. Here's the nominal yield. Where we are now is like this. The nominal yield is higher than inflation. So we got to turn this upside down. Now, there are 2 ways to do that. One is get inflation up, but that's not working. I mean, think about it. 6 years of QE1, QE2, QE3, currency wars, nominal GDP targeting, Operation Twist, jawboning, forward guidance. It hasn't worked. Nothing's working. Okay. So the Fed is an utter failure. So the inflation's not going anywhere. So the other way to do that is to bring the nominal yields down. Okay. But guess what? Inflation is still fading. It's going. So it's nominal yields. Nominal yields are chasing inflation down, trying to get to negative real yields. And Larry Summers, has said we're going to have negative interest rates. And by the way, he said that about 7-8 months ago, and that's where we are. Because when you get negative nominal yields, that's one way to get the nominal yield below inflation. If inflation is 0 and the interest rate is negative 50 basis points, you now have a negative real yield.
So isn't that, I mean, the Swiss basically said that. That's what they want. And that's what they have. They have negative, they have negative absolute yields.
Yeah, or I don't know if I misspoke, but when nominal yields are negative 50 and inflation 0, you have a negative real yield. But that's what's happening. Nominal yields are chasing inflation down to try to get to negative real yields. And that process is going to continue. It has a long way to go. And by the way, the DV01 at these levels is huge relative to higher interest levels. So people have never seen this in their lifetimes. I mean, you have to go back to the 1930s to find this kind of deflationary threat, but even then, interest rates weren't what they are now. And so this is something that no one has ever experienced, kind of consistent with the fact that Fed insiders will tell you it's a big science experiment, so you better be prepared to blow up the lab.
Oh, isn't that a wonderful idea?
Right.
Yeah. Now, if you roll this, we're going to take some questions here in a minute. The audience has a bunch of questions for you. We're going to have somebody come in and ask those. But if you play this into you're not like a political guy. I don't feel like I read a lot of politics out of you. How do you think that the U.S. presidential election reacts? Let's just assume, for argument's sake, that these crazy two guys that don't have 160 IQs are right. Let's say that bond yields are at 0.7, 0.8. You know, what does the debate look like? Do you think Jeb Bush runs on that?
Well, one of the nicest compliments I ever got on my first book, Currency Wars, somebody read it, said, Jim, I read your book, it's 300 pages, and there was nothing in the book that told me if you were a Democrat or Republican.
Right.
I happen to be a registered Republican, but the point is, he said, I read your book, and there's not. So I took that as one of the best compliments because I wrote it that way. I didn't really want to inject.
There's no politics
in it. Just kind of keep it.
There's anti-Fed.
Historical. Well, that's a criticism. That's analytical, but it's not political. And you got Republican. You know, Bernanke was a Republican appointee, and Yellen was a Democratic appointee. So
yeah, my question is, can they make that topic political?
Bipartisan incompetence when it comes to that, but. I think, well, here's the thing. Let's see how 2015 plays out. My expectation is they won't raise rates. If they do, there's going to be an earthquake, so be prepared for that. But my prior is they're not going to raise rates. Getting into 2016, I could see QE4 in early 2016.
Really?
Yeah, remember, QE2 was over in June 2011. QE3 did not begin until September 2012. It was a 15-month gap between the end of QE2 and the beginning of QE3. So QE3 was over in October, November 2014. So go forward 15 months, puts you in kind of February 2016. That's the tempo. I've only got, here's the thing, we talk about Frequentist versus Bayesian. If you're a Frequentist, we do have two data points on QE, which is QE1 was tapered 100%. People talk about the taper of QE3. Well, when you ended QE1, that was 100% taper all at once. When you ended QE2, that was 100% taper all at once. So we do have two data points on tapering. What we know is it fails because you have to come back again, which they did in QE3. So what would cause me to change that? I said, well, if the economy was fundamentally structured differently, you might get a different outcome, but it's not. Nothing has changed. So why should the taper QE3 end up any differently than QE1, QE2, which is it will fail. The Fed does not turn on a dime. We know that. They take months and they want to look at months of data, and they have to think about it and debate it and get a consensus and signal the market, forward guides. But you put all that together, I could see in early 2016 a little QE4, and then forget about raising rates at this point into 2017. No, they're not going to want to, whether you're a Republican or Democrat, regardless of your view, you're not going to want to cause this earthquake in front of a presidential election, although it did happen in 2008. I mean,
it also happened in 1979.
Yeah, I mean, it can happen because things can spin out of control on their own, regardless of policy.
Well, that's how I look at this last decade much more like, again, take away, the beauty of the politics is that they're bipartisan.
Right.
1970s Nixon and Carter had Arthur Burns, much like Ben Bernanke, maybe less prolific, but they had the same debt monetization theories, they had the same policies to inflate. And then you get Reagan to sign off on Volcker to start, really taking Carter to the woodshed, raising rates early.
Right.
And Carter would say, well, that's what killed my election chances.
Yeah.
Here you got Obama, and you got Clinton, and you have potentially Jeb Bush and whoever else is running alongside with him.
Yeah.
And I wonder if you get to the point where, like we started talking, and you said, it's collapse or it's leadership.
Yeah.
Like, is there a leadership point in this country where the new presidential candidate actually says, I don't believe the Fed works?
Well,
Isn't that what Rand Paul actually, what he delivered?
I think Senator Paul is saying that. I think other candidates are saying it too. I think you'll hear from Rick Perry and
I mean, like the head candidate, the top candidate. Like Romney didn't have it in him to say it.
No, and I don't think Romney's going anywhere. But look, Jeb Bush is trying to be, I'll say, moderate in his demeanor, not necessarily moderate in his policies, but he doesn't want to be the ranter. He doesn't want to be the guy banging the table, and you do hear that from some of the other candidates. But the key to getting the economy moving, the U.S. economy is capable of 5% growth on a sustained basis. Short term, and then on a longer term, capable of 3.5% growth, which we haven't seen since 2009. We've had 2% growth barely, and you go back to 2007, it's even weaker than that. Obviously, you take the effects of the recession into account. So we're capable of much higher growth, but not through monetary policy. There's nothing monetary policy can do to cause that. You have to have structural reform. What is structural reform? It's Fair Labor Standards Act, Keystone Pipeline, fiscal policy, regulatory policy, environmental policy, education policy. It's a whole host of things that are in the purview of the Congress and the White House that have nothing to do with the Fed. Now, right now, the Congress and the White House are barely talking to each other. When they do, it's just to poke a stick in the other guy's eye, right? So now, unfortunately, that dysfunction is going to carry through till 2017, when the new president's sworn in. A lot of people are saying, well, just get a new president there, Republican Congress, Republican president, et cetera. It'll all be good. I'm not so sure, because the Republicans had their chance in the Bush administration. They didn't show a lot of leadership on the kinds of issues we're talking about. So I don't know where it's coming from, to be honest, Keith. I mean, I keep looking for it.
Yeah.
I think Jeb Bush is saying some good things, but he's not. His background is social policy, education. Those are important things. He hasn't really shown that he knows a whole lot about economics. Now, I'm not saying you want a PhD economist or president. You almost certainly do not. But that's an area where he probably needs to bring up his game a little bit.
Yep.
We'll see what happens. On the Democratic side, Hillary, maybe she put Bill back in charge. We had a pretty good run in the 90s. I mean, the thing I always say,
strong dollar, rising rates.
Well, Bill Clinton was one of the great Republican presidents. If you look at the three landmark accomplishments of the Clinton administration, what were they? Free trade, balanced budget, end of welfare.
Yeah.
If that's not a Republican platform, I don't know what is. Yeah. So Clinton was a great Republican president, so maybe put him back in. So.
Yeah. This is, Jim, I just said this, but I'll say it again. I mean, this is the most questions I've ever seen in a queue ever. So obviously a lot of people, this is quite humbling actually, it should be. A lot of people obviously follow you and care about your work. So I'll just take them one by one. Junk bonds. Jim, junk bonds seem to not have gotten the deflation message yet. You've talked about deflation being on and off. How long do you think it will take for this market to go over the waterfall like oil did?
Well, I should be very clear, Keith. Everything I said about interest rates, real rates, nominal rates, bond market rally, that applies to treasuries. I'm talking about specifically 10-year U.S. Treasury notes. Does not apply to junk bonds, because there you're dealing with credit and credit spreads and a lot of other factors. So the junk bonds are not really going to be sensitive to the kind of interest rate dynamics we're talking about, because if you're a borrower and you have an option not to pay the money back, you're kind of interest rate insensitive. So that's not a good way to think about the junk bond market. The way to think about the junk bond market is from a credit risk point of view. I think it really, if you go back and look, it really rolled over in last summer. But there's a wave of defaults coming. I think we know where it's coming from. It's coming from trillions of dollars of bonds issued for energy exploration and development. Like, why is the price of oil so low? Because there's a lot of oil. Where'd the oil come from? It came from frackers. How did they do that? They bought pipe, the trucks, labor, et cetera. How did they finance that? They issued junk bonds. So, I like pulling up at the gas tank and finding that gas is $2 a gallon cheaper. It used to be $4, now it's $2. I like that as well as the next guy. Yeah. But look in your 401k. I talked to an investor the other day. I said, do you have 401ks? Yeah. I said, do you have any bond funds in your 401k? I said, I think I do. I said, do you know what's inside them? He goes, I have no idea. Oh, great. I said, take a look, call your broker, because you might find that these oil patch bonds are in there. Now, in addition to that, dollar-denominated emerging markets debt. Yep. Not sovereign debt. Sovereign debt, it'll get paid one way or the other, is well written. One said the countries don't go bankrupt, and he was actually right about that, but companies do. And there, BIS has estimated $9 trillion of corporate debt, emerging markets, dollars-denominated corporate debt. So you're looking at $10, $12 trillion. If the write-offs are only 20%, that's bigger than subprime. Jeez. So that's what's coming out. Now, even a borrower with negative cash flow who's about to go bankrupt can pay the principal and interest for a while. So this doesn't happen overnight. It's not going to happen tomorrow. But late this year, early next year, I look for this wave of debt. By the way, I mentioned I'm working on a new book. I also have a newsletter, Strategic Intelligence, Rickards Strategic Intelligence. And I'm trying out some of the ideas that will be in my book next year. Actually, work. This is the only place I write. I'm not a blogger, et cetera, so the only place I write is in the Strategic Intelligence newsletter. So we're covering a lot of these themes.
Great. Next question. I am in the real estate development business and would like to ask Jim, based on the predictions in his book, The Death of Money, what do you think will happen in New York City real estate if what he describes comes to fruition?
Well, the thing is, again, you have to separate nominal and real space. I mean, it could skyrocket in nominal space, but if the dollar is collapsing, then what good does it do? I mean, one of the interesting phenomena about the Weimar, we're all familiar with the Weimar hyperinflation, but one of the questions people ask is, well, that was horrible, 4 trillion Reichsmarks for a loaf of bread. How did that happen? And how did people let it happen? Well, one of the things, in the early stages of that, people were not worried about inflation because the stock market was going up. Like, all right, well, maybe my purchasing power is going down, but look at these stocks, And then, of course, the whole thing went to zero because the currency was worthless and a lot of companies are bankrupt.
Hate when that happens.
Hate it when that happens. So I would say, look, Manhattan real estate is being driven, it's really 3 markets. There's like the real market where people, young workers have to get an apartment. There's the kind of high net worth market. Then there's this ultra market. That's being driven by Chinese oligarchs, Russian oligarchs, South American drug lords. I used to work on 57th. A lot
of oil money.
A lot of oil money. I used to work on 57th Street, and I took the subway at 59th Street. So I'd walk around the Plaza Hotel, and for fun, I used to go out at night and say, I'm going to listen hard to see if I can hear English being spoken.
Yeah.
And I never did. It was Ukrainian, Chinese, it was every other language. But that part of town, look, I don't even want to call it a bubble because those buyers are not, it's inelastic demand.
Yeah.
Get me out of China, get me out of Russia, get me out of Ukraine, get me out of Colombia, Venezuela.
Same thing in London too. I mean.
So actually, well, that's a very good point. I see this all over the world. And I travel quite a bit, but I'll go to Melbourne, like, oh, we got a property bubble you wouldn't believe. Then I'll go to Sydney, and the property bubble you've never seen. Vancouver, oh, they call it Hongkouver because the Chinese are coming. But the point is, when you see, and Istanbul, I was there recently, same thing. Oh, you won't believe property. So when I see it all over the world, it's a global bubble. It's driven by inelastic demand from flight capital. It tells me something about emerging markets. It tells me that smart people in China are trying to get out while they still can. So I'm not sure where the person who sent the question, what segment of the market they're in, but it's a bubble, but it doesn't mean it can't go on for a while. And at the end of the day, your nominal gains might be wiped out by something like hyperinflation.
It's a vintage bubble.
Right.
Jim, Gunlack says the Fed will test the rate hike just to see what happens, then freak out and back down again. What do you think about that?
Well, again, I have a view that they're not going to raise rates, but we've talked about that. But they might.
The test, test?
No,
is it a game?
No, I disagree. I mean, look, I'm not saying they absolutely cannot raise rates. They might, but it's not going to be a game. That's not how the Fed thinks about things. They by the way, to do it and back off risks credibility, and the Fed doesn't turn on a dime. So if they do it, they're going to stay there for a long period of time and maybe try to see. That would actually tell me something interesting. If they do, it tells me that they've begun to weigh the costs of asset bubbles against whatever stimulus you might get from zero interest rates. See, if the Fed raises rates, it won't be because the economy is strong, because the economy is coming in very weak. We're seeing that in the data. It will be because they're worried about asset bubbles. But having said that, I have good reason to think that they're not worried about asset bubbles because they always miss them. So no, I can't see it as an experiment. No.
Yeah, it's interesting. Jim, what are you on the lookout for as a signal that you should reverse the deflation outlook as you had before, more to inflation, which I assume would reverse your bullishness on long bonds?
Yeah. By the way, I don't really talk about long bonds that much. I talk about 10-year notes, but yeah, that's a long or intermediate maturity instrument. Well, the problem is it could really turn on a dime. And what I do, in the past, my analysis, and this is very hard for kind of people to grasp, is we are on the knife edge of deflation, serious deflation of the 1930s kind, and something approaching hyperinflation, which I would define as 9-10%. A lot of economists say it's got to be worse than that. But so Russia
probably has that.
Yeah, so we could go to 4 or 5% deflation, which would be an earthquake, to 7 or 8% inflation very quickly. But the problem is we're right on the knife edge. So what I advise is a portfolio that's robust to both. So what would that look like? Well, you'd have some gold, silver, fine art, land. If you want to be in stocks, natural resources, energy, et cetera. Those are your inflation hedges. But you'd also have a lot of cash, which does very well in deflation, and you'd have 10-year notes, which do very well in a deflationary, disinflationary environment. So you'd have this sort of barbell with a lot of cash in the middle. People underestimate the value of cash. I mean, I manage a fund. We have a lot of cash in it. You know, the SEC beats us up. They go, hey, you guys are on a money market fund. People aren't paying you to manage cash. We say, well, they are paying us not to lose their money.
Yeah.
And we think that, and by the way, cash in a portfolio, it reduces the volatility of everything else that's going on. So you'll sleep a little bit better at night. It has huge embedded optionality, because when something goes wrong, you can be the person to pivot into the distressed class. Whereas if you get all in something, it can be hard to get out. And so you need this barbell. And it's frustrating because part of the portfolio is always going to be on the wrong side of the trade. Don't lever it up. One thing, in fact, cash is a good way to, is the opposite of leverage. But by the way, guess who's doing this? Our friend Warren Buffett. If you look at Warren Buffett, his last two big acquisitions were Burlington Northern Santa Fe Railroad and Suncor. What are they? Transportation, land, mining rights. You know, a railroad is all physical assets. How does it make money? It moves physical assets. It's freight, corn, wheat, coal, steel. So what's Suncor? Oil and natural gas. By the way, Buffett doesn't need the Keystone Pipeline. He can move his own oil on his own railroad.
Right.
As Hugo Stinnes did. He was the inflation king of Weimar Germany. He had coal mines and ships. And he could move his own coal on his own ships. He cleaned up in inflation. He made a fortune in the Weimar hyperinflation. So Buffett's got all those inflation hedges, but he has $55 billion in cash, the most cash that Berkshire Hathaway has ever had. That's right. That's the most cash they've ever had. What does it give? Well, it reduces all the things I said. Reduces volatility, it's a deflation hedge. So Buffett's got his inflation hedge in his hard assets. He's got his deflation hedge in his cash. He's got his optionality, so he can pounce when things get in distress. So he's my portfolio with like 6 more zeros or whatever. But that's the way he's positioned.
Yeah.
Now, he has this kind of avuncular demeanor. Goes on CNBC, talks about stocks. Everyone goes, Warren Buffett loves stocks. Now, Warren Buffett loves, well, he loves tax-deferred compounding, but what he really loves is making money and preserving wealth, and he's perfectly positioned. So it's frustrating because everybody wants to go all in one side or the other, and my advice is when you're on the knife edge, you need to be prepared for both.
Agreed. Mr. Rickards, including gold, which other currencies do you like?
Well, it's funny. 48 hours ago, I would have said Sing dollar, because
Really?
there were a couple strong currencies left in the world: Sing dollar, Korean won, a few others. But I was disappointed to see what happened in Singapore. But it is the logical extension of the currency war thesis. So what the Sing dollar devaluation tells me is that no one is immune from the currency war.
Yeah, they're the most
You hold out, but at the end of the day, if everyone else is doing it, you're going to join in. So maybe you watch Korea. So other than gold, well, look, I've always liked the euro because I think Europe's prospects are very good. And I know it's gone from 140 to 110 or 111. I get that, but I also recommended it at 120 and it went to 140. So now it might be at the low end of the range. I mean, QE in Europe is going to have very limited impact. I mean, the purpose of QE in Europe was not to stimulate. Draghi knows it doesn't stimulate. He gets that. It is the currency wars. It was designed to trash the euro. When you have a cheap currency, you import inflation. Everyone says, well, you do it to promote your exports. It can help a little bit in that. But the reason you really do it, the reason the Japanese did it, the reason the Europeans did it, is you import inflation. Because you have to pay more for all the stuff you buy, whether it's energy imports or anything else that you're buying. Chinese manufactured goods, Russian natural resources, et cetera. So now we're set up the way we are. So here's my thesis. The Fed and the Treasury have said to the world, in effect, we'll be the tough guy. We've got the strong economy. We're the locomotive, such as it is. We can bear the strong currency, and you guys can have the weak currency. You, Japan, and Europe, you guys can trash your currencies. You get whatever benefit comes from that in terms of importing inflation, because you're our trading partners. If you go down, we go down, so we'll throw you a lifeline. But that's based on an incorrect assumption. That's based on the assumption that the U.S. has somehow achieved, normalized, self-sustaining growth of 3.5%, which I doubt. I think the data is bearing me out there. So the interesting dynamic is, okay, at what point does the U.S. throw in the towel? At what point do we say, hey, we can't bear the strong guy. We can't be the tough guy anymore. We're going to pull back that lifeline, and your currencies are going to have to go up. Now, Japan will probably still cut them a break. You got to get yen to 180. I mean, they have a 2% inflation.
Yen 180.
Yeah. Well, they have a 2% inflation goal, right?
So monetary math.
Well, so the monetary math is, if you're trying to import inflation in the form of higher import prices, okay, what does Japan import? Energy. figure out what percentage of Japanese GDP is represented by energy, and where does the yen have to go so that when you pay a higher price for that, you get 2% inflation in the economy as a whole. I mean, it's a kind of a linear programming problem. When you do that, now see, it used to be 140. When yen was at 80 or 90, I mean, you could easily call it at 120, and you could kind of say 140, but what happened? The dollar price of oil collapsed. So even when you trash the yen, oil is still cheaper because the dollar price collapsed. Even though you need more yen to get a dollar, the number of dollars is way down. And so it's a moving target. To get the effect that 140 used to produce, you now have to go to 180. When I started in the banking business, the yen was 380, and we talked about it going to 450, so which it had been.
It's in the 80s?
This is in the early 80s, late 70s, early 80s.
The US dollar index was 140.
Yeah, but we used to do projections with yen 380, 450, whatever. But the point being, 180 is not historically out of line.
No, not even.
But the math is what I described. So we'll probably have to let the yen go there, which means that the great thing about cross rates is that it is a zero-sum game.
Yeah.
The dollar and the euro can't both depreciate against each other at the same time. So Europe's got all the help they need for the time being, but when the U.S. blinks, and I think they will blink by mid-year. See, the interesting time this year is
by mid-year.
Yeah, April, May.
By the way, you're going to front-run 6 questions in a row on this, which is...
But April, May is when I'm really going to be watching the tea leaves very carefully, because we know the Fed's not going to do anything this week. We know they're not going to raise in March. And if they want to raise beyond that, they have to signal. So April's the earliest signal. June's the earliest increase. But the data, the way the data is coming out, they're not even close to that. So the point is, by April and May, the market, which has already moved expectations back to September, December, is probably going to be into 2016. At that point, election year, start to talk about QE4, Bullard will be out saying something, and the point being, that's when the market's going to wake up and say, aha, they're not going to raise rates. They can't. There is no exit. This is easy money forever. At which point, and by the way, at that point, Europe's not going to do more QE. So at that point, this whole thing could flip. And so you might, so having said all that, I wouldn't place any big bets right now, but maybe by the spring, it's time to look at the euro.
Well, what's really sniffing out that scenario is gold's recent move. Really call it, I hate looking at year to date, but really the 1 month momentum in gold.
Yeah.
Gold loves down rates and down dollar.
Right.
And I try to say, well, just the arrest of the ascent of the dollar is enough for gold to start to really work again.
Yeah.
But in your playbook there, April to May, if the dollar is actually going down, that's where gold, do you think gold breaks up?
I think for a few months, maybe the dollar will stay strong on the assumption that the U.S. economy is stronger. See, going back to what we talked about earlier, Keith, with Bayes Theorem and the priors, the Fed's using the wrong model, so they're not going to know. They think the economy is getting stronger.
Exactly.
What's it going to take for them to realize it's going to get weaker, or it is weak? Well, the answer is data.
Yeah.
So let's see. We got fourth quarter GDP preliminary coming out this week. By the end of April, we'll have first quarter preliminary GDP revisions in second quarter, et cetera. It's going to take until April and May for until there's enough data for the Fed to start to change their thinking. It's only when they signal that the markets will say, aha, maybe the dollar should come down a little bit.
I think that's, the narrative, because people just don't, everyone does macro, but they don't do the right macro. Like Friday's GDP report's really important because you finally get the fourth component where you can have the year-over-year GDP number for 2014.
Right, which I don't think is going to be that impressive. It's positive, but it's still depressionary level growth.
But I remember driving to Mite hockey practice. It was the night of it was a Tuesday night. I was driving to Mite hockey practice, listening to these guys on mainstream media talk about the State of the Union, where the economy's booming 5%. Like they're all using this 5% number.
Right.
There's a very high likelihood that number, 2014's year-over-year GDP growth, was 2.
Correct. And by the way, that third quarter GDP, that was the most bogus piece of data. The Commerce Department did not adjust defense spending did not make a seasonal adjustment to defense spending. If you know anything about government contracting and defense spending, it's heavily, heavily bunched into the third quarter because the third quarter of the calendar year is the fourth quarter of the government's fiscal year because they end Sep 30, and bureaucrats hate to spend the money too early because they like to keep their options open, but if they wait too long, it's use it or lose it. So defense spending is heavily bunched in July, August, September period. That's why there's a seasonal adjustment. Commerce skipped it. It's like leaving the ground beef out of the chili. But remember that report came out 2 days or 3 days before the election. So it does seem that the Commerce Department has now succumbed to the same kind of political corruption we see in the Justice Department and elsewhere in the government. So I wouldn't put too much stock in that.
Question on team, just signal to me if we need to wrap this up, but I think we have a couple more minutes. Will Greece leave the euro, and will that cause the euro to fall further, or do you think they keep it together?
Greece will not leave the euro. They will not get kicked out. What's interesting is that 70% of the Greek people like the euro.
Yeah, oh yeah.
With good reason, which is they remember the drachma. And when they had the drachma, what did the government do? Printed drachmas, deflated the value, and they lost their savings and their retirements and all their income. So they like the euro. Now they kind of want it both ways. Like, we like the euro, but we don't like this, austerity and taking pay cuts and all that. Look, there's going to be negotiations. There's going to be some hardball. There are going to be good days and bad days, depending on what side of the bed Angela Merkel gets out of. But the bottom line is that no one. This is, we use the Hotel California. You get in, you can't get out, you can't check out. But this is the Fourth Reich. This is Germany taking over Europe, except they're not using military means this time. Margaret Thatcher.
That's a great chapter in your book, by the way.
Thank you.
I have people that invest. One in particular, he's based in Greenwich, long-short manager of only European long-short equities. And he's about as well-versed on Europe as anyone. I just literally took that chapter of your book and said, think about this long-term. What do you think about that? And isn't that happening?
I think
the German Reich is what
right. By the way, it's very, yes. And it's Margaret Thatcher in 1990-91 was bitterly opposed to German reunification. You had East Germany, West Germany at the time. And her thesis was simple. She said, hey, every time the Germans get together, they take over Europe. Why is that a good idea? She wanted to keep them divided. Well, guess what? They got together and they're taking over Europe. They're not using military means. They're using financial warfare, et cetera. But so they've got a big stake in this project. I've never understood the euro. The euro is not the euro currency is not an economic project. It's a political project. All the eggheads and the PhDs who are thinking about this the way you read a corporate balance sheet, take off that hat, put on your political historical hat, go back to Charlemagne. You'll see that this thing is not breaking up. Now, if it looks like there's some friction, they'll ease up a little bit. Maybe Germany will take a little more inflation to let the periphery off the mat a little bit. They could stand there, because remember, Draghi's targeting European-wide inflation. He's not targeting German inflation, deflation. So price stability in Europe, when you have a depressed periphery, probably means more inflation in Germany. And the Germans can actually do that. They can engineer it because they have these tight labor management relations. They can just give everybody a raise. You get a little more inflation in Germany. That'll kind of give the periphery a boost. So they'll find a way to keep it together. By the way, just one footnote, Keith. People, particularly Americans, have a really hard time separating the euro as a currency, as a project, from the cross rate. When I say that the euro is going to hang together, it doesn't mean the euro is going to 160. I mean, the cross rate will go where it'll go. I have a view on that, but saying the euro is going to hang together is not the same as saying it couldn't go to 105. I mean, maybe it will, maybe it won't. But separate the two things. I mean, we got to watch the cross rate every day if you trade it, but don't worry about the euro as a project.
I like that. And your book is very clear on that. I think that's very well articulated in your book. Jim, would you comment on the China-US dollar peg and how they factor into the war with a peg?
Well, China has always been a fairly easy read for me, which is that, again, completely political. Forget about what they teach you, purchasing power parity and all that stuff they teach you in college. Forget all that. It's political. China is like an out-of-control Ferrari that's got two guardrails, and they're trying to keep it on the road. Okay, one guardrail is unemployment. The other guardrail is inflation. They are both politically destabilizing in China. And remember, China, I have a separate chapter in my book just on China.
That was good too.
Thank you, which is that China's history is centralization, decentralization. Comes together, falls apart, comes together, falls apart. I call it the accordion theory of Chinese history. Right now, they're very close to the height of centralization. China has rarely, even under any emperors, it has rarely been as centralized as it is now, which means it only has one way to go, which is it's going to fall apart. And this is what keeps the leadership up at night. What could cause a popular uprising? What could cause China to fall apart? Inflation, unemployment. Now, this is where the currency comes in, because a cheaper currency helps with the employment situation, but inflation gets a little bit hot. A stronger currency hurts the employment situation, but it cools inflation down. So if you want to predict the cross rate, just look at inflation. When inflation's cool, they can peg to the dollar, have a little bit stronger currency. I'm sorry, I had that backwards. When inflation is cool, they will cheapen the currency to help the unemployment situation. But once they cheapen the currency, inflation will take off, then they'll tighten again. So if you want to know where the peg's going, watch inflation. When it's hot, they'll peg, and when it cools off, they'll cheapen.
It's just masterful central planning.
Right.
That's all it is.
Until it falls apart.
Wonderful. Jim, how important is CapEx in your view? Is that the real recession that's coming?
It's extremely important. This is one of the reasons I'm bullish on Europe, because they're going to get a lot of capital inflows from China, and a lot of that can go into CapEx. But one of the stories that's not in the marketplace right now is the extent to which major public companies slash their CapEx budgets in November and December. Remember, the price of oil, we saw that it really started to accelerate in September, and most large corporations have their business plans wrapped up by September. They take it to the board in October. There were a lot of revisions in November and December. This will trickle out into the marketplace over the next few months as companies, give guidance, et cetera. But it's not fully in the marketplace now. But CapEx is going to, is basically going to hit a brick wall this year, and that's one of the reasons why, going back to the Fed, this will become apparent over the next 60 to 90 days. And so by the time you get to April, May, it's going to, even the Fed will see it. Having said that, one of the ways that you can actually create economic growth, it's not by printing money, it's by investment. We're so driven. We're going to drive the economy with consumption. Aggregate demand. So the Paul Krugman thesis is, if you have 5 televisions, go out and buy a 6th one. And if you have 6, get a 7th one. Just keep buying TVs, and we'll get this economy moving again. It's not the only way to drive an economy. Maybe we don't need to buy that much stuff. You can drive an economy with investment. In my view, consumption is the payoff for smart investment. You do smart investment, you get growth, you create jobs, you increase incomes, and then you get to buy stuff.
You get to consume.
You don't drive the economy with consumption when there's no investment, there's no growth, et cetera, which is sort of where the Keynesians have it completely backwards.
They have it totally backwards.
So I think investment and CapEx are critical. We're not getting enough of it, and I think CapEx is suffering as we speak, and that's not fully in the marketplace yet.
I mean, yesterday we weren't shocked by it, but it was shocking to watch Wall Street react to the capital expenditure discussion from Cat Tractor's management team. These guys were completely and utterly shocked, in that October to December period.
Right.
Because they sell to a lot of oil and gas companies. Obviously, they've had issues on the mining side for a while, but that's what really got them. They couldn't believe that orders could be turned off that quickly.
Well, my advice would be, get away from your screens and go talk to the people who are actually running companies, and this is what they'll tell you.
I mean, it's so obvious.
Right.
I mean, do you think that once you get into, there's this thing called borrowing basis in the energy space, obviously, it gets reset every year in April. Now, all these borrowers have to deal with the new basis, which is based on the new price deck, which is based on the new cash flow assumptions, which is based on the new price deck for oil.
Right.
I mean, I look at that period, we've talked about it a lot, the timing of that risk to the debt market. When you talk about your really April-May time zone, I mean, to me, that really makes April-May and the seasonality of stocks selling off in that period anyway. Yeah,
but the reason I focus on April-May is because the Fed still has a rosy forecast because they have the wrong model. But that's the earliest period by which the data will be so clear that they're going to have to revise their forecast.
Right.
You and I can see it, others can see it, the Fed can't, but they will see it by the spring.
Yeah, they'll be under absolute duress from a political pressure perspective.
Right.
Well, I just want to thank you. I mean, these are a ton of questions. I could go on and on and on. I'm sure that you would actually probably answer them, since you're answering your own phone of 80-year-old grandmas calling you to ask you what to do too. So you've done a tremendous amount of work.
Thanks, Keith.
I think really all the work that at least I feel like I've been privy to over really the last 5 to 10 years of yours is really starting to flourish in terms of its relevance. So hopefully everyone who's watched this today buys all of Jim's books. You got to start with the first one, read the second one, watch everything that's going on currently, and then get ready for the third one.
And the dialogue is in my newsletter, Strategic Intelligence. That's a new initiative. I just launched that in October.
Is that October?
Last October, so we're in our 4th or 5th issue, having some fun with that. If you subscribe now, you can actually get the archives of the old articles. So go back to October. But that's where I'm putting out my more timely stuff.
How often do you write?
It's monthly.
Oh, monthly.
Comes out monthly, yeah.
Oh, perfect.
Yeah.